Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. Already 8 main problems I have completed on ratio analysis. Apart from this, 14 short questions I have completed, 4 videos on theory I have uploaded. If you are regular in watching all these videos, definitely at this moment you are in a position to understand, to solve the problem on ratio analysis. All the problems are based on the formula. You must remember the formula and also the significance of each formula. What it indicates, that you must know it. Then only you can be able to get the complete grasp on the topic of ratio analysis. Otherwise, this chapter normally students will find it difficult because they will not take much interest in understanding the formulas. So my suggestion, first of all, you should watch the first 4 theory videos in which I have explained each and every ratio in detail regarding the significance. So if you have watched all the 4 videos, then only you can be able to understand the problems. So I suggest you to go to the playlist of my channel. If you have not yet watched the earlier videos, go to the playlist of my channel, select the subject financial decision making. In that subject, you'll find the videos of ratio analysis. Watch the video, get a good grasp on the topic. And before starting the next problem, that is problem number 9, I expect my viewers to have a printout of the problems which are given in the link under my description. Always keep it ready. Take the screenshot of the solution of 9th problem, then I'll explain. Now, see the 9th one. The following information is obtained from the books of Rajni Limited for the year ended 31st December 2016-2017. So we are given 2 years balance sheet. Particulars: equity and liabilities, shareholders fund, share capital, reserves and surplus. Then non-current liability, 6% debentures. Current liability, trade payable, only one current liability. Assets, non-current assets, fixed assets, tangible assets, only tangible, we don't have intangible. Then current assets are inventories, receivable, cash and cash equivalent. The total of the balance sheet is given. Next page, it is given additional information. 2016-2017 sales 1,80,000, 1,95,000. Net profit 16,000, 17,250. Gross profit 40,000, 60,000. So we are given the sales, net profit and gross profit for both the years. You are required to arrange the above balance sheet figures in a form suitable for analysis and show separately the following ratios. A. Gross profit ratio. B. Operating ratio. C. Proprietary ratio. D. Current ratio. E. Debtors turnover ratio. F. Stock turnover ratio. So totally 6 ratios we are required to calculate for both the years 2016 and 2017. So it is easier to make a table. In tabular form we can be easily be able to calculate the given ratios. So here Rajni Limited, particulars 2016-2017. First ratio, gross profit ratio. The formula for gross profit ratio, GP by sales into 100. The gross profit is given in the problem 40,000. Sales are 1,80,000. So 40,000 by 1,80,000 into 100. 22.22% is the GP ratio for 2016. For 2017, the GP is 60,000. Sales are 1,95,000. So 60,000 by 1,95,000 into 100, 30.77. One ratio completed, gross profit. The second ratio it is asking you, operating ratio. The formula for operating ratio is COGS plus operating expenses divided by net sales into 100. So first of all, we need COGS. But COGS is not directly given in the problem. You must remember the formula. COGS is equal to sales minus gross profit. Already we have applied in the previous problem so many times. COGS, sales minus GP. So 2016, sales are 180, GP is 40,000. So 1,80,000 minus 40,000. 1,40,000 is the COGS. For 2017, sales are 195, GP is 60. So 195 minus 60, you will get 1,35,000. We got the COGS. Now operating expenses. The operating expenses are the difference between gross profit and net profit. Remember, from gross profit, if we deduct the expenses, we will get the net profit. Or if we add up net profit plus expenses, we will get the gross profit. So operating expenses is equal to GP minus NP. Gross profit minus net profit. So here GP minus NP. So 2016 40,000 is the GP, NP is 16,000. So 24,000 expenses. For 2017 60,000 is the GP, NP is 17,250. So operating expense 42,750. Now we add up COGS plus operating expenses. COGS 1,40,000. Operating expense 24. 140 plus 24, 164. So 1,64,000 divided by net sales 1,80,000 into 100. Similarly for 2017, how much is the COGS? 135 and operating expense 42,750. 1,35,000 plus 42,750, you will get 177,750. Divided by sales 1,95,000 into 100, 91.15. So two ratios we have completed, gross profit ratio and net profit ratio. The third ratio it is asking you, proprietary ratio. The formula for proprietary ratio, net worth by total assets. And net worth means shareholders fund. Net worth means shareholders fund. And shareholders fund consists of share capital and reserves and surplus given in the problem. Specifically given. Share capital 1 lakh, reserves and surplus 67,250. 167,250 is the shareholders fund or net worth. Similarly for 2017, 1 lakh plus 84,500, 1 lakh 84,500. Total assets are given in the problem itself. Balance sheet total 3 lakh last year and 3 lakh 7,000 current year. So here simply substitute 1 lakh 67,250 divided by 3 lakh 0.56. 184,500 divided by 3 lakh 7,000 0.60. This 3 lakh and 3 lakh 7,000 are the total assets. Balance sheet total. That's all. Three ratios we have completed. Now fourth ratio is current ratio. It's very simple. Current assets by current liability. So current assets are inventory, receivable and cash equivalent. So if you see the balance sheet given in the problem, inventories are 56,160, trade receivable 11,250, cash and cash equivalent 15,380. 82,800 are the current assets for last year 2016. For 2017, the total current assets are 87,190. This is inventory, receivable and cash. So total. Then current liabilities are only one given in the problem, that is trade payable. That is the current liability. 32,750, 22,500. Now divide 82,800 divided by 32,750. 2.53:1. That is the current ratio of 2016. For 2017, 87,190 divided by 22,500. You'll get 3.88:1. That's it. So, three ratios, four ratios we have completed. 1, 2, 3, 4 ratios. Now, fifth ratio is debtors turnover ratio. The formula for debtors turnover ratio, net credit sales divided by average debtors. Net credit sales, we don't have the information about cash sales, credit sales, only sales are there. So we assume whatever sales are given, that are credit sales only. That is our assumption. So numerator will take the sales. Denominator average debtors. Average debtors means opening debtors plus closing debtors divided by 2. But opening debtors are not at all given. So we take the closing receivables. So whatever receivables are given, that are debtors. So last year debtor and current year debtor. Closing receivables we will take. So 1,80,000 divided by 11,260. This is 11,260. Then 1,95,000 is the sales, 11,710. These are the receivables. So 15.99 times and 16.65 times. This is the debtors turnover ratio. 5 ratios we have completed. Now sixth and last ratio, that is stock turnover ratio. The formula for stock turnover ratio is COGS divided by average stock. Cost of goods sold divided by average stock. COGS already we have calculated here. 1,40,000 and 1,35,000. No need to calculate again. So COGS we have. Average stock. Average stock we can calculate when we have opening and closing stock. But in our problem, for 2016, we don't have any opening stock. So for last year 2016, we take the closing stock. So whatever inventory is given for 2016, that only will take. So inventory for 2016 is 56,160. So we will take 56,160 for last year. For current year, we have opening stock as well as closing stock, because 2016 closing stock will become 2017 opening stock. Last year's closing stock will become current year's opening stock. So last year's closing stock was 56,160 and current year closing stock is 49,460. That is given in the problem. This is the inventory of last year, this is the inventory of current year. So we add up 56,160 plus 49,460 divided by 2. We'll get 52,810. This is the average stock of 2017. So for 2016, we have not calculated average stock. We have taken the closing stock. For 2017, we have calculated the average stock because opening and closing both are given. So 1,40,000 divided by 56,160, 2.49 times. This is a stock turnover ratio. 2016. 2017, 1,35,000 divided by 52,810, 2.56 times. That's all. So this is the end of problem number 9. Come on. Now we'll start the next problem. Problem number 10. The balance sheet of an income statement of Neha Limited as of 31st March 2017 is as follows. So we are given the balance sheet and also we are given the statement of profit and loss of Neha Limited for 2017. So first of all, balance sheet, equity and liability, shareholders fund, only share capital is given, no reserves and surplus. Then non-current liability is their long-term debt. And current liabilities are 2, trade payable and accrued expenses. So total of the balance sheet 8,000. Now asset side, fixed assets 4,500. Current assets consist of inventory, receivables and cash equivalent. So balance sheet completely given. Then statement of profit and loss account of Neha Limited for the year ended 31st March 2017. Revenue from operations, that is nothing but sales, 8,000. Expenses are cost of revenue from operation 3,300. This is cost of goods sold, COGS. And finance cost, these are the interest charges, interest on debt, that is 367. Other expenses are 3,000. Total expenses are 6,667. Profit before income tax is 1,333. Income tax 533. So net profit after tax is 800. This is the statement of profit and loss showing the profit for the year. Calculate the following ratios: A, B, C, D, E, F, G, H, I, J. So totally these are the ratios we have to calculate. One by one we will calculate. First of all, first ratio is current ratio. The formula for current ratio is CA by CL. As usual, current assets are given 3. Inventories, trade receivable and cash equivalent. Inventory, trade receivable, cash. So totally 3,500. Current liability consists of 2 items. Trade payable and accrued expenses. Outstanding expenses. So add up 2,000. So 3,500 current asset, 2,000 current liability. So current ratio CA by CL, 3,500 by 2,000, 1.75:1. That's it. Next one. Second one is debt to total assets ratio. Debt means long-term debt. The formula will be long-term debt divided by total assets. So long-term debt is given in the problem. Non-current liability, long-term debt is given 2,000. And total assets are 8,000. So 2 divided by 8.25. That's it. Next ratio is interest times interest earned. The new wording is used. Actually, this times interest earned is nothing but interest coverage ratio. Name has been changed. We have seen in the ratios the name was interest coverage ratio. But in this problem it is saying times interest earned, means same. So formula for interest coverage ratio, PBIT divided by fixed interest charges. PBIT, profit before interest and tax. So we are given PBT, profit before tax is given. To this profit before tax, we add back the interest charges, that is finance charges. So finance charges are 367. So 1333 is the profit before income tax. But we need profit before interest and tax. Before interest we want. So we have added back the finance cost. So 1700 is the profit before interest and tax. So PBIT divided by fixed interest charges. Interest charges are 367. Finance charges or interest charges means same. So 4.63 times. This is the times interest earned or interest coverage ratio. The next thing is average collection period. The formula for average collection period is number of days in a year divided by debtors turnover ratio. So before calculating average collection period, we need debtors turnover ratio. The formula for debtors turnover ratio is revenue from operations divided by average receivables. But average receivable we can calculate only when opening and closing both are given. So we are not given the opening receivable. So we cannot calculate average receivable. In that case, we take the closing receivable. So in the balance sheet, current assets, you will find receivables. That is the closing trade receivable. That will take a denominator. The revenue from operation 8,000 and trade receivables given in the balance sheet is 2,000. So 8,000 by 2,000 4 times. This is the debtors turnover ratio. Now simply we can calculate average collection period. Remember the formula. Number of days in a year divided by debtors turnover ratio. Number of days in a year 365 divided by 4, 91.25 days. This average collection period will be in days. That means our customers are paying in 91.25 days. That means we are allowing to our customer 3 months time period. If we sell the goods now, the customer will pay back in a period of 3 months. That is the meaning of average collection period. Next is inventory turnover ratio. Stock turnover ratio, inventory turnover ratio means same. Cost of goods sold or cost of revenue from operations divided by average inventory. But average inventory we can take only when opening inventory and closing inventory is there. Then only we can calculate the average inventory. But in our problem, opening inventory is not given. So we take the closing inventory. Right? So 3,300 is the cost of revenue from operation given in the problem. Directly given cost of revenue from operation. And average inventory we cannot calculate. The closing inventory 1,000. So inventory you can see here, inventory 1000. That inventory I have taken 3.3 times. This is the inventory turnover ratio. Next is fixed assets turnover ratio. The formula is revenue from operation divided by fixed assets. It's an old formula. Already so many problems we have seen in the past. So revenue from operation divided by fixed assets. Revenue from operation are 8,000 given in the problem. And the fixed assets are 4,500. That is also given in the balance sheet. So it comes to 1.78 times. The next ratio is total assets turnover ratio. This is also an old ratio. Revenue from operation divided by total assets. Revenue from operation given in the problem 8,000. Total assets given in the problem 8,000. 8,000 by 8,000 one time over. Next one is return on total assets. This is also an old problem, old formula. PAT divided by total assets. Profit after tax given in the problem 800. You can see the statement of profit and loss. Profit after tax 800. And total assets are given 8,000 into 100. Why into 100? Because it's a profitability ratio. Whenever there is a profitability ratio, we multiply by 100. So 10%. Now return on common equity. This is the return on equity shareholders fund. The formula for return on equity shareholders fund is PAT minus preference dividend divided by equity shareholders fund into 100. So PAT is 800. We don't have preference share capital. So there is no preference dividend. Similarly, equity shareholders fund. We have only equity capital. We don't have any reserves. We don't have any surplus. So how much is the equity share capital? 2,000. So into 100 it comes to 40 40%. This is the return on common equity. Last ratio is operating profit margin. Operating profit margin. So the formula is operating profit divided by revenue from operations into 100. Whenever there is a return, you should calculate it as a percentage by multiplying into 100. So operating profit by revenue from operation into 100. Operating profit is not given in the problem, so we have to calculate. The revenue from operation minus cost of revenue from operation will get the gross profit. Revenue from operation minus cost of revenue from operation will get the gross profit. From gross profit, deduct the operating expenses. Don't consider the financial charges, only operating expense, other expenses. So operating profit is equal to revenue from operation minus cost of revenue from operation minus other expenses. So you can see the statement of profit and loss. Revenue from operation 8,000, cost of revenue from operation 3,300, and other expenses given in the problem 3,000. Deduct, you will get operating profit, that is 1,700. Now operating profit margin. So 1,700 divided by 8,000 revenue from operation into 100. You will get 21.25%. So we have completed problem number 10. So far we have completed 10 main problems and 14 short problems on ratio analysis. If you are regularly watching all the videos, definitely, inshallah, you will be in a position to do any problem on ratio analysis. Still some more problems are there. We'll continue this in the next class. But if you are satisfied with my lecture, give a like to the video. Share my channel in your friends, in your circle, so that more students can watch the video and enhance the knowledge. And give your comments from which university you are pursuing your course, which course you are doing. Just give me the comments, give the messages. I will respond, inshallah. And apart from this, I have started one more channel by name Khan's Accounting Institute. And that channel I have uploaded the videos on for IGCSE students. So you can watch that channel also to gain the knowledge, command on accounting, finance, management subjects. Inshallah, we'll continue the next problem in the next video.